All right. We are picking up where we left off. The segment margin. Actually, let's just review this real fast here. Um, traceable fixed costs are salary, like the salary of a product manager, maintenance cost of a business segment, the liability insurance of a business segment. Common fixed costs are more than one segment, so salary of a CEO of various divisions, cost of heating in various departments in a Walmart, salary of a receptionist of various doctors at a doctor's um, place of business, doctor's office. Um, okay, so and then we have a segment margin, which is calculated by taking the contribution margin for a segment and subtracting the traceable fixed costs of a segment, and that will give us a segment margin. And then to prepare a segmented income statement, we need to take sales minus variable expenses to get the contribution margin for a segment, which is how we normally get contribution margins. Okay, just picking up the segment margin, which is what we just read, is obtained by deducting traceable fixed costs of a segment from the segment's contribution margin. It represents the margin available after a segment has covered all of its own costs. The segment margin is the best gauge of the long-run profitability of a segment because it includes only those costs that are caused by the segment. If a segment can't cover its own costs, then that segment probably should be dropped unless it has important side effects on other segments. Notice common fixed costs are not allocated to segments. From a decision-making point of view, the segment margin is most useful in major decisions that affect capacity, such as dropping a segment. By contrast, as we noted earlier, the contribution margin is most useful in decisions involving short-run changes in sales volume, such as pricing special orders that involve temporary use of existing capacity. Segment margin is most useful in major decisions that affect capacity, such as dropping a segment. Contribution margin is most useful in decisions involving short-run changes in sales volume, such as pricing special orders that involve temporary use of existing capacity. J.C. Penney is bringing back its catalog. I didn't know they were still in business. All right, in 2010, J.C. Penney discontinued its catalog when in 2010, JCPenney discontinued its catalog that was first published and distributed in 1963. However, once the company realized that many of its online sales came from customers responding to what they saw in print, it reintroduced the catalog in 2015. In other words, JCPenney realized that catalog shoppers and internet shoppers are not independent customer segments. If retailers such as JCPenney separately analyze catalog sales and internet sales, they may discontinue the catalog segments while overlooking the adverse impact of this decision on internet segment margins. Identifying traceable fixed costs. Okay. So traceable fixed costs are like a single segment. The distinction between traceable and common fixed costs is crucial in segment reporting because traceable fixed costs are charged to segments and common fixed costs are not. Oh, yeah, that makes sense. In an actual situation, it is sometimes hard to determine whether a cost should be classified as traceable or common. The general guideline uh, is to treat as traceable costs only those costs that would disappear over time if the segment itself disappeared. Okay. For example, if one division within a company were sold or discontinued, it would no longer be necessary to pay the manager's salary. Um, yeah, that's interesting. Therefore, the division manager's salary would be classified as a traceable fixed cost of the division. On the other hand, the president of the company undoubtedly would continue to be paid even if one of many divisions was dropped. In fact, he or she might even be paid more if dropping the division was a good idea. Therefore, the president's salary is common to the company's divisions and should not be charged to them. When assigning costs to segments, the key point is to resist the temptation to allocate costs, such as depreciation of corporate facilities, that are clearly common and that will continue regardless of whether the segment exists or not. And then they note any allocation of common costs to segments reduces the value of the segment margin as a measure of long run segment profitability and segment performance. Okay, this is kind of boring to read. I'm living up to my name. Uh, oh, right. For example, if one division within a company were sold or discontinued, or no. Traceable costs, only those costs that would disappear over time if the segment itself disappeared. Do we have a definition of a segment? My gosh. There you go. A business segment is a portion of a business that generates revenue from selling a product or a line of products or by service, so, providing a service. Cool. So, like Walmart's sporting goods department segment, instead of department, because they're different, but they're the same. Um, when assigning costs to segments, the key point is to resist the temptation to allocate costs. Okay, I'm moving on. Traceable fixed costs can become common fixed costs. Well, that makes sense. Fixed costs that are traceable to one segment may be a common cost of another segment. For example, United Airlines might want a segmented income statement that shows the segment margin for a particular flight from Chicago to Paris, further broken down into first class, business class, and economy class segment margins. The airline must pay a substantial landing fee at Charles de Gaulle, I think. Substantial landing fee at Charles de Gaulle Airport in Paris. This fixed landing fee is a traceable cost of the flight, but it is a common cost of the first class, business class, and economy class segments. Even if the first class cabin is empty, the entire landing fee must be paid. So the landing fee is not a traceable cost of the first class cabin, but on the other hand, paying the fee is necessary in order to have any first class, business class, or economy class passengers. So the landing fee is a common cost of these three classes. Segment reporting at the Villar Performing Arts Center. The Villar Performing Arts Center is a 535 seat theater located in Beaver Creek, Colorado that presents an unusually wide variety of performances categorized into 6 business segments: family series, Broadway series, theater, comedy series, dance series, classical series, and concert series. The executive director of Villar, Chris Sable, excuse me, it's boring, must decide which shows to book, what financial terms to offer to the artists, and what contributions are likely from underwriters, uh, also known as donors, and what prices to charge for tickets. He evaluates the profitability of the segments using segmented income statements that include traceable costs, such as costs of transporting, lodging, and feeding the artists, and exclude common costs such as his salary, the salaries of his staff, depreciation on the theater, and general marketing expenses. Data concerning the classical series segment for one season appears below. All right, 4 numbers of shows, the seats budgeted, seats sold, average seats sold per show, ticket sales, underwriting, total revenue, artist fees, other traceable expenses, Classica series segment margin. Although classical series sold an average of 164 seats per show, its overall segment margin, 21,699, is positive thanks to $65,000 of underwriting revenues from donors. Had common costs been allocated to the classical series, it may have appeared unprofitable and been discontinued, resulting in fewer shows during the season. Less diverse programming, disappointment among a small but dedicated number of fans, and lower overall income for the Villar due to the loss of its classical series segment margin. Segmented income statements. An example. Profit Max Incorporated is a rapidly growing computer software company. Let's see. Hmm. This is interesting. All right. ProfitMax Incorporated is a rapidly growing computer software company. Exhibit 6-6 shows its variable costing income statement for the most recent month. As the company has grown, its senior managers have asked for segmented income statements that could be used to make decisions and evaluate managerial performance. ProfitMax's controller responded, excuse me, I'm bored, by creating examples of contribution format income statements segmented by the company's divisions, product lines, and sales channels. She created Exhibit 6-7 to explain the consumer products division's product profits and can be further segmented into the clip art and computer games product lines. Finally, the computer games product lines profits with the consumer products division can be segmented into the online sales and retail stores sales channel. Okay. Divisions, product lines, sales channels. So these are segments. Okay. Levels of segmented income statements. Exhibit 6-8 contains the controller's segmented income statements for the segments depicted in Exhibit 6-7. The contribution format income statement for the entire company appears at the very top of the exhibit under the column labeled Total Company. Notice the net operating income shown in the column shown in this column, 13,500, is the same as the net operating income shown in Exhibit 6-6. Immediately to the right of the total company's column are two columns, one for each of the two divisions. We can see that the business products division traceable fixed expenses are 90. My gosh. Oh, this is so boring. Um, okay, so we have the segments defined as divisions, segments defined as product lines, customer product division, products, And I'm tired. Alright, let's just read the highlighted stuff, see how far we get. Let's refer again to the bottom portion of Exhibit 6-8 to illustrate how segmented income statements support decision making. Notice that online sales segment has a segment margin of 48,000 and that retail stores segment has a segment margin of 3,000. Let's assume that Profit Max wants to know the profit impact of discontinuing the sale of computer games through its retail sales channel. The company believes that online sales of its computer games will increase 10% if it discontinues the retail stores or the retail stores sales channel. It also believes that the business products division of the and clip art product line will be unaffected by this decision. How would you compute the profit impact of this decision? The first step is to calculate profit impact of discontinue the retail stores sales channel. If this sales channel is eliminated, we assume its sales, variable expenses, and traceable fixed expenses would all go away. The quickest way to summarize these financial impacts is to focus on the retail store segment margin. In other words, if the retail store's sales channel discontinued, then its negative segment margin of 3,000 would also be avoided. This would increase Profit Max's net operating income by 3,000. The second step is to calculate the profit impact of increasing online sales by computer games by 10%. Okay. To compute the break-even point for business segment, so and this is the segment traceable fixed expense divided by the segment ratio, contribution margin ratio. Okay. All the costs attributable to a segment only and only those costs should be assigned to the segment. Unfortunately, companies often make mistakes when assigning costs to segments. They omit some costs, inappropriately assign traceable fixed costs, and arbitrarily allocate common fixed costs. like sleeping here. All right. All of costs attributed to a segment, and only those costs should be assigned to the segment. Unfortunately, companies often make the mistakes when assigning costs to segments. They omit some costs, inappropriately assign traceable fixed costs, and arbitrarily allocate common fixed costs. Costs that can be traced directly to a specific segment should be charged directly to that segment. Should not be allocated to others. Practically speaking, absorption costing is required for external reports. Use absorption for both. Cool. Let's hit some questions. When a segment is eliminated, now a common cost is going to remain, a traceable fixed cost will disappear. So common costs will remain unchanged, and we can just look at that right here. The traceable fixed cost will disappear. That will, yeah, I think that's it. Costs are categorized by function. Costs are categorized by function when using blank costing, and by behavior when using blank costing. Oof. Well, if I'm going to think about this logically, categorized by function and by behavior. So I would say variable costing would be by by behavior, and we'll say absorption. Only costs that would disappear over time if a segment disappeared should be treated as a what is it called? A fixed traceable. The difference in net operating income between absorption costing and variable costing is due to the it's the manufacturing overhead, specifically the materials, the indirect materials. Bart's Incorporated operates retail stores in various cities. Segmented income statements are prepared for each store and for each product line in each store. The property tax for the store is a blank fixed cost for the store, and a blank fixed cost for each product. Well, I'm going to say traceable fixed cost for the store. Yeah, the store is going to be common. Store has more things in it, so like, oh, well, got that backwards. Net income computed under may not agree with the results of a CVP. It's absorption. And segmented income statements should only be used by profit centers, are best used to determine which locations are profitable. Wait, segmented income statements. I think this is absorption. I remember reading this. Huh. Variable. I would have said absorption. Oh, I'm so tired. Oh, SPS Products has two divisions, catalog sales and online. Excuse me. For the last quarter of catalog sales, segment margin was 5,000. Online sales were 100. Online sales contribution margin was 60, and its segment margin was 40. If catalog sales are discontinued, it is estimated that online sales will increase by 10%. Oh boy. Yeah, I don't know. So let's read this example. The first step is to calculate the profit impact of discontinuing the retail store's sales channel. If the sales channel is eliminated, we assume its sales, variable expenses, and traceable fixed expenses would all go away. Quickest way to summarize these financial impacts is to focus on the retail store's segment margin. In other words, the retail store's sales channel discontinued, then its negative segment margin of 3,000 would also be avoided. This would increase Profit Max's net operating income by 3,000. The second step is to calculate the profit impact of increasing online sales of the computer game by 10%. To perform this calculation, we assume that the online sales total traceable fixed expenses, 15,000, remain constant, and its contribution margin ratio remains at a constant of 63%, which we find out by dividing 63 by 100,000. All right. Well, it's lunch. I'm going to take lunch. We'll be back.